Good afternoon. It's Peter Klein, Chief Investment Officer, co-founder of Align Wealth, with you on this day, 24th day of February 2022. We all, I guess we went to bed last night knowing that Ukraine has been invaded by Russia, and it is an important event, but not one that I think will frame our investing protocols going forward. So I'd like to brief you on what we see as the opportunity set and the case for international investing. Here we are with an international incident, a geopolitical incident, and here's your chief investment officer telling you that maybe we should be considering international investments. Well, that's what contrarian investing is all about. That's how you find the best prices. Now, we've been speaking about the case for international investing for some time, but obviously we don't see the invasion of Ukraine as being as derailing that case. So allow me to share my screen with you so I could present to you the case. Okay, so again, thank you for your time today, and I will endeavor to walk you through this quick case for international equities. Okay, why? International equities now, they're cheap, they're relatively and absolutely cheap, and there are different constituents inside the indices. You know, the European and Japanese markets have different indice makeups that, in our view, allow us to be on the value side rather than the growth side, and we believe that's where we want to be going forward. So framing the opportunity, here's a list. This chart, they do the fellow Smith Schroders provides this for us, and it looks at the equities from different parts of the world each year. And what you could see here that's intriguing is this. Since 2018, and you could argue from 2011, I bet you could even go back to 2009, it's been US pretty much all the way. Japan has been down here, as has Europe. The contrarian in us wants to buy what's unloved and therefore cheap. Over the longer period of time, a market cycle, 3 to 5 years, it has been shown that if you do that, that is the very best way to outperform. So do not chase, buy what's cheap, and wait. Let's go to the next slide. And this, I think, also speaks to that same kind of contrarianism. As you can see here, U.S. equities have been on a tear. Even through this period. Look what happened when the U.S. equities were last on a tear. Ba-boom. You see, it's a regression to the mean. What happened here? Ba-boom. So we haven't seen the other side of this yet. I think that's coming, where the U.S., where non-U.S. equities outperform. I think that's coming. It's been a long period where it's been U.S. outperforming. This is another slide that speaks to that. Look at the longest stretch of U.S. outperformance in history, going back to that 2009, or out of the great financial crisis, where the United States had embarked upon QE perhaps more aggressively than the EU, and certainly longer than the EU. And that's provided us. And again, as we said earlier, the makeup of the U.S. indices are more growthier, more tech, and that obviously played into the lower interest rates, jet fueled that outperformance of those higher growth multiple stocks. I think we're on the other side of that, though, and here's the opportunity. Buy what's cheap and out of favor. Here we're looking at value, and in the context of the MSCI EFA index, and as you can see here, consistent opportunity to buy what's cheap. So it has probably it's fairly cheap, if not very cheap, relative to its averages. This is 3 standard deviations there. So it's almost 3 standard deviations off the mean. So that's pretty cheap. And I tend to think washed out and opportunistic. Value EFA. In other words, buying those, the value style, right, with cyclical materials, financials, energy in Europe, EU, and around the world. We're not talking emerging markets here. We're talking about developed markets. Some of these companies have been around for hundreds of years, blue chip and opportunistic. Here's again that same kind of value versus growth, but again under the lens of the EFA index, which is essentially everything but US and without emerging markets. So it's developed markets ex-US. And as you can see here, value has started to begin to big difference. So I think we're beginning this what will likely be a long ball game of value outperformance internationally, and just coincidentally also domestically. That's a different ball game a bit, but definitely internationally. And now the U.S. versus the rest of the world, ROW. That's a new acronym, so you can impress your friends at the next party you go to and say something like, well, you know, the ROW of the So anyway, this is the cyclically adjusted price to earnings ratio. You folks know the CAPE. We speak about it a lot at Align Wealth. That's Bob Schiller's work from Yale University, Nobel laureate. And what he has done is look back hundreds of years and essentially smoothed out the earnings of companies and therefore of the PE over a 10-year period of time. So you're not looking at, oh, here's our earnings versus our price and our PE is this. You're saying, well, let's look at the earnings over a 10-year period of time, rolling 10 years. And therefore, it's a bit smooth for the business cycle and issues that come up, right? Exogenous issues. And so that is the way we do the way the CAPE is done. So it's a wonderful way to look at the price to earnings multiple over an extended period of time. And what this is showing us is the MSCI index, the USA in black versus the ROW. And you can see much lower, right? So this is dangerous territory. We know that. We're seeing that change a bit today with the markets the last couple of weeks, with the markets coming in a bit, but we're still seeing opportunity here relative to the US, as well as absolutely cheap. Similarly, we see that same here, 14.5. This is the forward PE ratios. This is not a CAPE. This is forward earnings, right, compared to current prices. The U.S. now is probably closer to 19.5, given the last couple of weeks. But these also have come down. But you can see the difference. And listen, I drink at the font of U.S. exceptionalism, of course, as well, to a point. I mean, we have to be very mindful of what we're buying and the price we're paying for it. And right now, I think the ROW, the rest of the world, is fairly cheap. So the time is right now for international investing. Japan and the EU are more cyclically focused. Financials, industrials, consumer, discretionary. That's where we want to be. The US, which is geared more to IT and hence growth. So you see the different makeup of the indices internationally and the US. As rates rise in the US, as the rates rise, US indices will have a tougher time as the S&P is more than about 60% growth focused, where the UK and the EU and Japan are more cyclically value focused. So the opportunity here is not only the differential between the valuations and therefore the cheapness I've suggested, but also the fact that the makeup of the ROW indices are more cyclically and more value focused, which I think, as we showed on the slides, are opportunistic right here. So you have a double whammy here, double opportunity, a double win. Cheapness and the cyclicality value focus of these indices. And this gives you a sense of what that looks like. As you can see here, the EFA has 26% of financials to the S&P's 10. materials of 10 to 2.6, energies 2.7 versus 6.2, industrials 11.9 versus 7.8. So you could see, of course, down here, this is probably why the ROW, the international markets, haven't done as well over the last few years with interest rates coming down. That has ginned up the terminal value of high multiple stocks, ergo IT and consumer discretion to some degree. And the EFA index doesn't have that as much percentage there as we do in the US. Consequently, the flip side of that is that the EFA index is more value focused than the S&P. S&P is more of a growth index. And so you see more opportunity potentially there as well. Okay, I hope I laid this out for you. I appreciate your attention. At Aligned Wealth, we're seriously focused on our clients, making sure you understand what we're thinking, how our strategy. We've discussed the strategy over the last few months and are happy to discuss it again with you, and to also go over your financial plan, a deep dive, a robust financial plan for you and your family that focuses not just on the cash flows in retirement or pre-retirement, but also focuses on the opportunity to look at estate planning and legacy planning, right? What's the legacy going to be, and how do we want to be able to frame that within the value statement of the family? So thank you for your attention. Peter Klein, wishing you a good weekend, and we'll talk with you soon. Thank you.